Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork, and happy Friday. It's Friday, December 4th. Hope you guys got great upcoming plans for the weekend. Probably get some of that Christmas shopping done, right? Hey, we got a couple important economic news releases to go over today, and as we mentioned, this is the big one this week. We got the non-farm payrolls brought to you by the Bureau of Labor Statistics. So we had a revision of October and November payrolls, which actually were increased. October came in at 298,000 new jobs created. So obviously very good numbers there. Forecast for November was at 200,000, came in at 211,000. So everybody's pretty riled up about the jobs numbers. We're real excited about that. Now remember, if you followed my recordings, I said November and December, always be a little cautious with the job numbers coming out with that, because a lot of those jobs are temporary positions for the holidays that the retailers hire for people for holidays working and stuff. We still got lower than what we should be at participation rate in the employment force. Employment rate is good at 5%, so basically no change rate there on the unemployment rate. So that's good right there. We haven't seen any changes in that regard. Average hourly earnings is going up, which is always a good sign. Same pattern. Went up 0.2% in October and went up another 0.2% in November. Same as the forecast. Trade deficit came in kind of probably a little bit of a surprise here. We had $42.5 billion back in September, and October we forecast at negative 40.6, so it's supposed to be a little bit better and actually worse than that, 43.9 billion. So that kind of came in as probably a little bit of a surprise there. But the main ones we're looking at are the jobs numbers, the non-farm payrolls, unemployment rate, and average hourly earnings on those numbers. So what does this translate? Basically, it pretty much puts a stamp on it that the Fed will probably be raising rates on the December 16th meeting when they give their announcement on December 16th. So basically, everybody's saying that. A lot of the Fed members have been speaking. They're all kind of saying that they're in favor of a rate hike. So basically, they're saying that it's going to be a rate hike. So it jumped up percentage up to about 79% that they'll raise it. So most likely that will be the case. That will happen. So don't be surprised if they raise rates. It will be about a quarter point on the short-term rates. Now, sometimes this does help out the bond market, primarily because the bond market's biggest enemy is inflation. And when the Fed's raising rates, that means they're trying to fight inflation. And by fighting inflation, that rallies the bond market. It helps protect the bond market. Stock market's up. We're up. Dow's up over 200 so far this morning as a result of the job numbers. So they're liking what they're seeing, saying that they're starting to believe that the economy is on strong foothold, even though it's at a very moderate pace of about 2%. That they can hold a quarter percent a rate hike. So the next question after that would be in 2016, how many more rate hikes are we going to have and by how much and stuff will probably be the next questions going forward. So be prepared for that in the coming months as to when and if the Fed might raise the next have their next hike. OPEC decided to raise their production. As a result, the cost per barrel actually went down. So they did decide to raise their productivity on creating more barrels every day, oil barrels every day. So, which of course more supply but less demand, so lower their cost. Bond market, as you can see, we had a huge drop yesterday. It dropped about 75 basis points. I forget exactly the exact number, but we're in that basis. So basically, a no-point loan that started the day yesterday basically went up to 3/4 of a point. So pretty big drop there. Right now, we're up about 25 basis points from where we left off yesterday. So that's pretty good. So you can see we're making a little bit more headway. So basically, we hit our previous lows. We hit our previous highs before, and now we got our lows here. We kind of touched off them yesterday and today. So that could be a driving force to bring us up, back up over the 10-day moving average, bring us back up, probably close to this range again. What you'll probably see here in the near future. But yeah, yesterday was a bad day for stocks and bonds alike. All right, folks. Hey, you guys have a wonderful weekend. Our interest rates are a little bit better because yesterday was such a well, put for better words, a disaster when you see how much of a drop it did. But we did have a bit of improvement today compared to where we left off yesterday. All right, folks, you guys have a wonderful weekend. See you guys on Monday. Thanks so much for watching. Take care.